Hey everyone, it's PJ Patterson here for Market Update. Today is Monday, November 2nd. It's late in the day, and I've been watching the Australian market and some of the pre-markets before I did my update this week because this is going to be a big week. You probably know why, which my first of my top three things are going to be the election in the US, followed by volatility, which I think is being largely driven by this uncertainty around the election. And then finally, the US dollar, again, going to hit on that and a number of other things related to the dollar, as we've been talking about over the last many updates that I've been leaving of late or been giving you of late are very dollar centric and also centric on volatility. But first, the US election. So we have Joe Biden, the Democrat, versus Donald Trump, the incumbent Republican. It's up for grabs, I think. There is certainly a lead by Biden in the polls, but who knows? This happened last time when Hillary Clinton and Donald Trump were facing off as the two candidates. Hillary Clinton did have a lead, probably not as substantial as what Biden's appears to be at this point, but then it was a massive turnaround and Donald Trump took the election. So will the same thing happen again? I really do not know. I don't really have any skin in the game or a horse in the race, as it were. I live in Australia now. The U.S. to me is, yes, it's my original home, but Australia is absolutely my home now. And so, whilst I watch what goes on there with interest, because it is still the financial center of the universe for much of the planet, politics from a political point of view, I kind of don't care. But it will be interesting because both men have different policies that are going to affect how markets trade. And I think that's one of the reasons why we've seen so much volatility. So moving on from the U.S. election of course, the U.S. election is going to be held on November 3rd, but we won't, that'll be our November 4th, of course, and we probably won't really see results till late at night on November 4th, and maybe not even until November 5th. So we'll just have to wait and see. And of course, they're predicting that with all the mail-in votes and all this other stuff, they may not actually have the election called potentially for weeks. So, it's going to be a very interesting election cycle because of the influence of COVID and the mail-in ballots and people maybe not, going to the polls because of the fear of COVID. So anyway, again, it's just going to be super interesting. Now, again, leading into point number two, which is volatility. The markets have been exceptionally volatile. And in fact, if you are paying attention to any volatility metrics, you can sort of see it here on the edge of my screen. I've got the VIX and VIXN and some other volatility metrics, oil volatility. And certainly in the last week to 10 days, we have seen volatility rising. And I think it has to do with the US election and really just uncertainty in the markets. Traders and people are trying to position for the election outcome, but there's just undecided. And when that happens, you just see a lot of volatility get created. Now, I also believe that this particular bout of volatility is a big cluster, obviously, of volatility, but I don't think it's going to trend, meaning we're going to see this long-term elevated volatility level. In fact, I think once the U.S. election is decided, or we get a sense of, what the outcome from it is really going to look like, we hopefully will see volatility subside, and we will actually see the markets sort of return to their hopefully uptrending nature. The fact that the U.S. is going to be in Quad 3, Australia Quad 2, I'm going to touch on that in a moment after I talk about the U.S. dollar. But I'm going to let the global macroeconomic environment drive the decision-making process around the investments that we make. So this, again, is a volatility spike because of a certain event, the U.S. election. That's what I think is going on. As a few more days pass, and certainly by the end of this week, we will get a much, much better sense of that. But the way I've sort of I have been buying back into equities, taking advantage of this sell-off. I've been buying weakness because I think once the election's decided, we're going to see everyone, traders and the like, coming back into the markets and rebuying these positions they've sold. And I'm going to show you some data points on that, things that I've shown you before, but certainly things that I will show you again to reiterate that. Now, finally, let's talk about the U.S. dollar. Let me get my couple of charts up for you. So again, the U.S. dollar right now, as you can clearly see from this chart, is in a downtrend. Now, you're going to get little spikes in the dollar, right? Like we're seeing a counter trend move right here. But look at this chart. It's showing you the dollar peaked back in June, early June. And ever since then, it has been on a decline. We've had moments in time when the dollar has rallied for whatever reason, but it has continued its decline. It will continue to do so. Both candidates' policies are effectively, so in other words, what I'm saying is it doesn't matter who wins the election, whether it's Biden or Trump, the dollar is headed lower. And as you know, because I've been showing it, I'm just going to quickly flip over to it. The dollar has some very key correlations. It's negatively correlated to a number of asset classes. And at the moment, you see a very strong negative correlation over a 30 and 90-day period to gold, to commodities, and also to the S&P 500. So not so much with oil, but I think that's coming back. We are seeing that now. I think we'll see that correlation begin to realign itself to being a much stronger inverted correlation, because the oil market seems to be maybe pricing in, beginning to price in a little bit of recovery. Who knows? We'll see how oil trades. But certainly over 120-day period, oil has a reasonably high correlation to the dollar, inverse correlation to the dollar. But again, those other things I just mentioned have a stronger inverse correlation. I think I said this in the last update or the one just before that. Commodities broadly are heavily correlated, as you can see. Oil is the last of the Mohicans, really, of the major commodities that really do affect what goes on this planet to domino, that is. I suppose oil is the final domino to fall. So once oil really starts to resume that strong negative correlation to the dollar, number one, you're going to see energy stocks and the such like going bonkers. But of course, you'll see the entire commodity complex going nuts, including gold, silver, etc. So again, just watching these key correlations is another thing. If you get the dollar right and the direction of the dollar right, you're going to get a lot of other stuff right in global macro. So this is why I continue to highlight it to you and to pay very close attention to it. It drives a shitload of stuff around the planet still, and it's not going away anytime soon. A lot of people are calling for the Chinese and stuff to step up and replace the dollar. Probably not going to happen in my lifetime. Could, but it probably won't. Maybe it will in the next 100, 200 years. In fact, I would have no doubt that it will at some point, but we shall see. Now, going back to a couple of other key things that we talk about, I just want to go back quickly, touch on earnings. We have more companies updated. So almost now 2/3 of the S&P 500 have reported. Now, obviously, these numbers have come back up, which I expected they would. We're still seeing negative earnings growth for the year, but particular segments are looking particularly nasty. So like in the financials, we have most of the companies reporting pretty bad earnings miss there. Industrials, majority, I would say, at this stage have reported. That's a horrendous miss. And of course, energy companies probably looks to be about half of them, a little bit more than half have reported. And they've had an absolutely horrendous quarter, understandably, because the oil price has been so depressed. So other than that, other sectors have fared a bit better. IT, communications, utilities, they've all done pretty well comparatively. So I will continue to show you this table as it gets updated. Now, one of the things I want to talk to you about is the strategy now that I have taken advantage of this volatility, because I was sitting on a very high level of cash in client accounts. And I was sort of waiting for there to be an opportunity to position portfolios for what is coming in the first half of 2021 in the US, particularly in Australia, and also big time in Asia. And that is, we're going to see a raft of quad 1 and 2 setups or data in Australia, in Asian countries like China, Japan, Taiwan, Indonesia, Thailand. We're going to see probably quad 2 in the US at some point in the first or second quarter of next year. And sort of globally, we're going to start to see, hopefully, us coming out of the doldrums. Now, one of the exceptions to this is going to be Europe. They're still really, really deep in the shit. And that is a technical financial term. They're deep in the shit. and they're having their second wave hit and dealing with all of that. So their monetary authority, which is the European Central Bank, looks like they're going to step in at some point with a massive stimulus program that will help them. But right now, Germany, which is one of the key economies in Europe, and France for that matter, but Germany is in quad 4, which is really, really bad. So having said that, I'm not looking to touch Europe with a 10-foot pole and have chosen instead to invest heavily and take positions, not invest heavily, but take positions in technology. So NASDAQ, and there's a couple of Australian ETFs, ATEC and NDQ, which are ATEC is specific to Australian tech sector, and then the NASDAQ is just, again, the NASDAQ index. But wanting to take those exposures because in quads 1, 2, and 3, growth is typically, well, quads 1 and 2, growth is definitely an asset allocation that you want, and that means tech, so they're secular growers. Energy is also a big component, so I've been adding energy at this point because I think we're bouncing somewhere around the bottom of the energy market, and these earnings here would certainly give you an indication that it, well, hopefully can't get much worse for energy companies, but they're priced accordingly right now. They've been beaten up badly. So again, energy does well in quads, quad 2 in particular, because that's sort of an inflation. There's inflation issues there. It also does well in quad 3. But anyway, long and short of it is energy have added further added exposure to Japan, Taiwan, India. So emerging markets. So as the dollar declines, emerging markets do well. So we want exposure to emerging markets. And of course, Australia is included in all of that as well. We're not an emerging market, but we have a lot of exposure from our national balance sheets perspective to emerging markets because we sell Taiwan and we sell, well, not so much Taiwan, but let's say we sell China and Indonesia and Japan and Korea, even for that matter, a lot of raw material to produce the goods that they produce. So anyway, long and short of it is repositioning now, allocating a lot of cash to all of these positions, and I'm just going to sit and wait now. There's really not anything to do except to wait and be patient. Now, having said all of that, the markets could continue to show some volatility. One of the things I'm really proud of at the moment is even though the Dow and the S&P 500 were down probably last week 3-4%, maybe 5%. I don't know specifically how much they were down. But yes, we saw a little bit of a decline in our in accounts, but nothing more than 1%. So in terms of being a fund manager, the alpha difference is probably 3 to 4%. All that means is, and it's not a position that I want to key in on too much, but even though accounts decline, they didn't decline as much as the broader markets. So that's a good thing. Obviously, we don't want accounts to decline at all, but sometimes that's going to be what happens in the very short term as you get volatility clusters and things like that. So anyway, I'm now positioning though, and this is the key point that I want you to hear from me today, is I'm now positioning, and I'm very comfortable with the longer term game. So by long term, I mean I'm looking at the next 6 to 12 months of how we need to be invested. And I'm saying to you, we're investing for quads 2 and 1 in Australia, in much of the Asia Pacific region, quad 3 in the US, hopefully moving into a quad 2 scenario early next year, and basically a world that right now, even though it seems like we are at a very dark moment, not as dark as it was when COVID was at its sort of peak a few months ago, but we're certainly now beginning to see those signs of economic resurgence, countries getting their shit together and beginning to perform, and the world sort of reopening coming out of this COVID doldrum. So hopefully, touch wood, we will not see any big resurgence or any need to go back into a lockdown or anything of that nature. And of course, if we get a vaccine from anybody, then that's going to just light a fire under the market. So as soon as we get a vaccine that is tested properly and doesn't kill anybody or cause a bad side effect, if that can be broadly distributed, then I think you're going to see a lot of confidence return to, in particular, the stock market. So that'll be a big trigger event, I think, for humanity as well, is the creation of a vaccine that, again, isn't harmful to people and actually does what it's supposed to do, which is, vaccinate you against a COVID virus. So anyway, we'll see what happens there. I think that's about it for today. So if you do have any questions, please hit me up in the chat, send me an email, give me a call, book yourself in. Again, just a reminder, you can go to the Facebook closed group, which is the boardroom, and you can book yourself in for an appointment. For those of you who want to have a portfolio review or what have you, please don't hesitate to book that in. Happy to do that. But again, patience is the order of the day. We've avoided a lot of the carnage. We did not see drawdowns in accounts during this early part of 2020. We've been well positioned over the last 6-7 months of being patient, taking small opportunities here and there to make some money, but have kept the capital base intact. And this is so important, and I keep saying this over and over again because I want it to sink in. In times like this, there's a tremendous amount of uncertainty, and keeping your capital base as intact as possible is critical, because now that I'm putting the army to work, as it were, the army of money to work, we have it all intact, and we're very well positioned now, buying into a bit of weakness to take advantage of it. In fact, that's the one thing I was just racking my brain as to what I wanted to show you. There is, again, a lot of implied volatility premium in the market. So when you see this table that I'm showing you here and you see a lot of green, that means there's a lot of people that are really scared and trying to hedge this volatility. Now, the key thing here that you need to take away is when you see these big implied volatility premiums, it typically occurs after the volatility has occurred. So people will buy fire insurance after the building is on fire or after the building has burned down. And again, this is another very interesting metric that I use to sort of govern when to place trades and things like that, and when to put stuff on, is that typically when you see an extreme, it often will mean that you're at a capitulatory point where people are either hedging heavily or they've sold or whatever. And it's often a good sign that the worst is maybe over. But anyway, it's not a guarantee, of course, but it is a good sign. Considering when you look at, say, a month ago, and this is a very interesting chart, column in this table to look at, is the 1 month ago premiums were not very high, which again suggests that, and they were negative in terms of the NASDAQ, which is the Qs, and the technology sector. And when it's negative, it means that people are very complacent. And again, that's a moment in time where you might say to yourself, well, I'm actually going to take some profit here, because people they think it's only blue sky ahead. It's only going to go up. So anyway, this implied vol premium discount table is a very, very important table when I show it to you. When you see a lot of green and you see a big green number, like, over 30-40%, good sign that we've probably had some volatility in the market. Maybe that asset class has come down a bit, but B, is probably the time to go and buy it. So anyway, it's just another tool that is used in my overall business to make better informed investing decisions and choices. So there you go. Let's stay tuned for the election. It's going to be an interesting week. I certainly hope that the world doesn't end as what many people are sort of prognosticating. They're going to have riots and stuff in the U.S. I sincerely hope that does not happen. And I wish the best of luck to all my brothers and sisters in the U.S. that this election outcome will be good and that the country can sort of move forward. So it will have a big impact, I think, though, on financial markets. Expect a lot of volatility around the event. And then I would expect that to probably subside. So any questions, concerns about anything, please let me know. Other than that, have a great week, and I'll talk to you again soon. Bye-bye.